Okay, so we're going to start with Bruce. Over to you.
Unmute.
Bruce? Bruce, I think you're on mute.
Sorry about that. It's a bit classic, isn't it, to actually be the speaker who's on mute. But anyhow, now, after the full start, thank you for the introduction, Alex, and thank you all for turning up this evening to see us. We can no longer say thank you for coming through all this horrible weather and everything, because you're all sitting at home, which is something we've learned to do during this pandemic. But anyhow, thank you for coming along. I've been excited about this event ever since Alex asked me to be the warm-up act for the two fantastic speakers we've got coming later. I noted in his introduction that he said that I had a wide spectrum of experience, which by most measures means I'm old, which I truly am. So I'm going to very briefly go through what we're doing here this evening. Firstly, I'll give you my background and disclaimer, tell you my personal opinion of how we got to where we are now, and then get the crystal ball out and see what we may be doing, where we may be going in the future. And there will be questions after all three speakers, so I won't take any questions after this. I've got a background, as Alex said, public school educated, went to university, studied marketing, finance, and management. I qualified in City with a chartered accountant firm, and then I took a little bit of experience in commerce and industry before being recruited in 1982 into one of the very first venture capital funds that was setting up, utilizing the tax advantages that have continued and grown since then. And so my career since then, I've just followed where the wind blew me, basically, but I did have an end game in play. But I started with the venture capital fund. I was raising money, I was investing it on behalf of the fund, and I was monitoring them, which meant that I sat on the boards of, at one stage, I was on the board of over 50 different companies. And I then went from that into advising the businesses, went upstream as it were, and ended up in the last 15 years of my career actually running businesses, all with the major objective of taking early retirement, which is what I was very fortunate to be able to do. Lots of people may have that objective. I was lucky enough to be able to get that. However, I must, before I go on, give you a disclaimer. In the 1980s, I was a licensed dealer in securities. That meant I could have talked you in, out of your money to put you into any kind of investment that was around. Fortunately, they took that away from me. No, actually, it expired. Also, as a member of the Institute of Chartered Accountants, I was allowed to give people advice. I no longer do that because I'm a retired life member. And so I'm no longer permitted or authorized. Oh gosh, we have some American spelling in there, I apologize for that, to give investment to people, advice to people. But so everything I say, everything I say tonight is simply my personal opinion. If you decide, after hearing anything I've said, to invest, do not rely on anything I have to say. Seek professional advice. I will now go on to what I'm really going to talk about. Back in the day, back in the 70s and 80s, when I first started managing investments, they were mainly investment funds or trusts, family stuff, charitable trusts. Obviously, with my name, a lot of Quaker influence over that. And what we used to do is we used to exclude companies for moral, ethical, or political reasons. We took out alcohol. We took out armaments. We took out tobacco, and we took out, for political reasons, South Africa. And that was pretty much the environment in which the investment community moved forward from, I suppose, from the 1970s onwards until the 1980s, when there was a bubbling under of movement towards ethical investment. Not necessarily at that stage green investment, there were a few, but mostly it was ethical. And then it sort of became a bit sustainable. And then over the last 3 or 4 years, suddenly what happened was that it sort of flipped in a major way. And it suddenly became sustainable, green. That was the focus. That is the focus. And in the last year with the pandemic, what we've seen happening throughout that time is that we've seen the effects of having a far lower carbon footprints from things like travel, from international aviation. We've experienced cleaner air. And what's more, and this didn't actually start with the pandemic, but it really was brought on by it, is the big money, and I mean big money, started to get behind green and sustainable investing. People like BlackRock, who are the biggest people in the world, came out with sustainable funds. Who is it? The North American pension funds for teachers, which are massive. They're trillion-dollar-sized funds. They started to invest or buy companies who were already investing in green and sustainable investments. So we moved on from there, and what's happened? The environment for people who are investing in publicly quoted shares, ones that you can buy on the stock market or whatever, has now got a really good infrastructure for helping you. Dow Jones, there's the Dow Jones Sustainability Index, there's the FTSE for good index series. And when I say series, both Dow Jones and the FTSE have got indices for all kinds of things. And on top of that, there is the ethical consumer. Now, I don't know how many of you know about ethical consumer, but they're a very good organization. They come out with research. They have got a list of publicly quoted unit trusts and the like that you can invest into. And just as an example, this thing, VH Global Sustainable Energy Opportunities. I mean, doesn't it say it? It says it does what it says on the tin. I can't remember whether this is an investment trust or a unit trust. If you don't know the difference, talk to somebody about it. There is a big difference. But basically, what is happening in that public space at the moment is that you can invest in a variety of different things. And when I say you can invest, it's not only you, but also your pension fund. Don't forget about that. And then on the private side, if you are prepared to take a far higher degree of risk, the crowdfunding platforms are available, and you can invest in. I've just picked up some of the ones that I've seen over the last week or so. Wave Piston, which is taking energy out of the waves. That's on the Cedars website. We got what's it called? Plumo, Plwumo, which is using feathers to replace expanded polystyrene for packaging. It's all green. And there's hydro wind energy, another one. These are all available either on Cedars or Crowdcube or Angel's Den, or you look at the whole host of investment platforms out there. So it's both an exciting and a dangerous time, and I would really urge you to listen at this point to the detail of it, because There are massive opportunities there. I don't just mean getting into Tesla. If you got into Tesla this time last year, you've troubled your money, or getting into Ørsted, who I don't know if you know about Ørsted, but 15 years ago, Ørsted were the BP of Denmark. They decided way back that there was no future in fossil fuels. They decided the future was in green energy. They are now the world's largest manufacturer of wind turbines. They're an incredible company. Their share price has gone up. There are dozens of companies out there that are doing incredibly well, but we're also in a danger zone. We're talking, and if you're talking about all of this, they are markets. And frankly, it doesn't matter whether or not you're dealing with green energy companies or pork bellies in Chicago. The same thing happens. If you've got more buyers than sellers, the price will go up. If you've got more sellers than buyers, the price will go down. It doesn't matter what business you're in. That's the fundamental of economics. And at the moment, there are far more people who want to invest into green energy projects than there are green energy projects available. That is driving the price up. What happens when that happens is, yeah, the price goes up. Some people get in there because they want to be speculators. That's fine, part of the normal course of a market. But other people want to get in because there are opportunities to perhaps take an unscrupulous advantage of people who don't know so well. So you have to really be careful to understand the fundamentals of what you're going into. And when I mentioned earlier about the investments that are available on the websites for Cedars and Crowdcube and that sort of thing, the wave pistons, the hydro energy, the Plumo, the feathers thing, I get probably 20 plus of these sort of proposals across my desk every week. Now, the first thing I do is I put them through my filter, my venture capitalist filter. I say, you know, is there going to be a market for this? Are the people who are proposing it, have they got experience in running a business? Are they going to be able to grow it? Are they going to be able to put a team together to grow it? And in the end, are they going to be able to sell the business or get it into a state where it becomes really valuable and move on? And probably 50% of them, they fall at that first hurdle because they just don't get in. But of the other 50%, I should think getting on for now about 80% of them, I won't invest in because they're just being too greedy. They value their companies at some ridiculous thing. They say, well, if Tesla can be valued at more than General Motors, why can't my business? Well, the answer is, you know, there are question marks about why Tesla, which hasn't actually turned a profit yet, can be valued as at more than General Motors. But you have to be really, really careful. So proceed with extreme caution. That's my major thing of that. You don't want to fall into the trap of the people who are really persuasive that you can become a spreadsheet millionaire. You don't want the FOMO effect happening to you. And actually, I agree with Alex, or I slightly disagree with Alex, that it isn't just about green investing. It's a wider thing. I think that I personally take a more holistic approach because I don't think you can invest just in green companies. That brings you up to date with where I think we are now. So it's time to get the old crystal ball out and look and see whether or not what the future has to bring. Is it going to be stormy or is it going to be sunny? Well, this is a chart which I'll just leave there and give you a few seconds to absorb, because it really tells us all how we have managed to right royally mess up our planet. My grandchildren and my great-grandchildren, should we manage to pull ourselves back from the abyss by 2050, they're going to turn around and they say, how the hell did you allow this to happen? It should never happen again. They will say that. But you know what? In 1921, people were saying we should never have war again. Memories fade quickly. But anyhow, that is the state of the planet at the moment, and we're going to have to bring it back from the edge. And how do we do that? By, is it green investing or investing into the sustainable agenda? I think first and foremost, it's not just about green energy. The focus, obviously, has been on the Paris Agreement, on the getting to net zero, and a lot of that focuses on getting green energy, getting ourselves off the addiction to fossil fuels, taking ourselves away from mass aviation transportation, getting ourselves away from having motor cars to do all these fancy things that you don't actually need to do, getting ourselves away from having energy generation from coal and from oil. We've managed to do that incredibly well in the UK. We've been breaking records week after week with green energy generation. And I think that we've still got way to go, but we're really managing to get on top of that. But we have to accept that between now and 2050, when hopefully we will have turned the corner, we're going to need to do some massive infrastructure projects. We're going to really have to cope with migration. Why? Because between now and 2050, there will be sea rise changes. There will be climate changes that cause people to want to go away from the shores of their countries, that cause people to want to get away from parts of the world that are becoming either drier, hotter, or where the desert is encroaching. So there will be a lot of things going on which are mitigating the effects of climate change. We can't stop climate change. We know it's already happening. It's going to happen more and it's going to happen worse, and we're going to have to tackle that in partnership with getting to our 2050 changes. And on top of that, we're going to have massive societal change. We're beginning to see little green shoots of it now. You know, in our consumerism, people are becoming marginally more aware of the ecological footprint of the products and services they're buying. By the way, I refuse to use the word carbon footprint. It was coined by British Petroleum. They coined it because they didn't like the word ecological footprint, because fossil fuels look worse when you look at them through the ecological footprint prism than through the carbon footprint prism. So ecological footprint is the terminology to use, not carbon footprint. We're beginning to change our diet. I think a lot more people are aware of the benefits of vegetarianism and the disbenefits of eating beef. I think that we're going to see some, in the same way as we've seen some massive changes of going away from fossil fuels, I think there's a very good chance that we're going to see some massive changes away from using soya products and from other things where palm oil products, where we know that the side of that is the destruction of forests and a really negative green aspect. I am really sad that the company that now bears my name, which is now owned by Monzella, but they are one of the biggest users of palm oil, and I think that's horrific. The other thing is, sorry, but I think everybody has to understand that mass travel will have to be significantly reduced one way or another. And so the thought of holidays, flying off 3 times a year to the south of Spain, whizzing off to Prague for a hen do, that's just out of the question now. And of course, we're going to have all the political changes. Countries are approaching the climate crisis with completely differing attitudes. You know, you've got most of Northern Europe are really beginning to get behind things, but Hungary, Turkey don't even, you know, they don't even accept the fact that there is any kind of climate change going on. So, you know, there are going to be some fairly big and sweeping changes. So what do I think is going to come next? And what do I think you should be doing? I think you should keep a finger on the pulse to see what's going on. Read it up. Make sure you know what's going on out there in the marketplace. The second thing you can do, because I'm sure you've all got some form of control over it, is to make sure that your pension is following a green agenda and not funding fossil fuels and everything else, and if possible, only investing in businesses, in companies which have a sustainable agenda for the future. But for those still in employment, I think the biggest thing is make sure that wherever you're working, it's not vulnerable to a non-green or an unsustainable future. There are an awful lot of people who are still working in businesses that are going to suffer because of the switch to a greener agenda. There are also a huge number of opportunities opening up for people to get into areas which are serving the green agenda. People who have got who can get into the whole management of the green energy sector and the like. So, what the last thing I would do is support the entrepreneurs, the projects, the organizations, and anybody with a sustainable future agenda, because I think that that is the way that we are all going to get out of this one way or another. Thank you very much.
Excellent. Thank you so much.
Back to you, Alex.
That was great. We're now going to move on to Molly Scott Cato, who is the Green Party spokesperson for finance. Molly's going to give more of a regulatory background to this topic. So over to you, Molly.
Yeah, it's really interesting to hear from Bruce, because I would say I'm incredibly risk averse where money's concerned, and also so suspicious that I sort of put it in something that's just down the road, or I spend it. So I'm like the opposite of Bruce. And as Alex said, my only involvement in this is that I'm a politician, and so I'm trying to constrain some of the worst things that Bruce perhaps himself used to do, let's hope not, but other people that, you know, work in the investment field might be trying to do. And I did that as a member of the European Parliament and as a member of the Monetary Policy Committee there. And they say talk about what you know, or is it write about what you know? Anyway, I'm only going to talk about stuff I did as an MEP and then make 3 brief wider points at the end. So actually it was very nice being on that committee, because as Alex pointed out, I've studied economics and I'm a professor of economics, and I was able to use what I understood about the green economy to influence the agenda that took off sort of in the middle of my term, which was all about sustainable finance. And I actually organised to have an initiative report in the Parliament, and I was the rapporteur for that report, and that sort of set the groundwork for the positions we were going to take as European parliamentarians on this really large agenda that the Commission was just starting to roll out. And they have a big action plan on sustainable finance, which includes lots of different aspects of how to make sure that you know what's happening with your money and you can send your money in a green direction, and also setting minimum standards for the whole of the market. So I'm going to talk about 3 bits of legislation under that umbrella, 2 of which I worked on myself, and the 3rd one I was involved with, but I didn't directly work on it. So the first 2, they sound a little bit technical, but I'm going to try and explain, because I'm a lay woman when it comes to this as well. I'm not an experienced investor like Bruce, but I'm going to try and explain what the terminology means. And if I don't explain anything, then just please ask in the questions. So the first one was what they called climate benchmarks. And this, this often happens with European legislation, that they use the wrong word, and benchmarks is actually the wrong word here, because the word they should have used is indexes. And so what that means is, Bruce was talking about how you might put your money into one company, but really big investors or small investors who sort of group together, but the big pension funds, for example, they don't tend to invest in individual companies. There are financial companies that arrange these indexes, and the big investors invest in those. So they group together a number of companies sort of to balance the risk, and also to make sure that you're investing in a more efficient way, I would say. And so when now we're talking about green investment, there are quite a few bundles of green investment called indexes. And what the European Union was trying to do was to make sure that these were regulated in a way where if you invest in something that's called a sustainable index or benchmark, as they said, then you can be sure that your money will be doing things that are good for the environment and not the reverse. And so they sent us 2 benchmarks, which were called, I can't remember what they were called because we redesigned them. But anyway, they're both focused on climate. So making sure that if you want to invest your money in a way that helps us address the climate emergency, here are groups of companies you can invest in that are guaranteed to do that. And they've got the sort of EU stamp that says, yes, this isn't greenwashing, this is for real. So the first of those benchmarks is called the Paris Aligned benchmark. I myself called it that. And it is about having minimum standards in terms of the greenhouse gas intensity of what the companies are doing who are part of that group of companies in the index. And they include scope 1, 2, and 3 greenhouse gas emissions. And as a whole, the output of greenhouse gas emissions by those companies has to be at least 50% lower than the emissions of what they call the investable universe, which we might think of as an average. So in order to have when we wrote this down as Greens, we obviously had it much stronger than that, but then we have to go through all the process of negotiating with other groups, negotiating with Romania. It wasn't Hungary, it was Romania in this case, but it's usually Poland, whatever. So the best of this was sort of watered down, but still it's a pretty strong benchmark. And one of the people that came to talk to me about shifting their money in the green direction was the Japanese pension fund. So you can imagine the sort of vast sums of money that might shift into this kind of direction if we set these benchmarks up well. So that's the Paris Aligned benchmark. And the second one was the climate transition benchmark. And there we're thinking about, because actually the most important thing here is not the companies that are already doing green stuff. Of course, they are really important, but they're already over there. And then you've got the companies that are just going to have to die, like fossil fuel companies, a lot of aviation companies, in my view, but companies that are just uninvestable as part of in a sustainable future, in a net zero carbon future. But the important stuff is the stuff in the middle, the stuff that is going to exist into our future, which we have to force to transition to be sustainable as quickly as possible. And that was the point of this climate transition benchmark. So companies in that pool of investments have to have CO2 emissions that are 30% lower than the investable universe, and they must be have a yearly decarbonisation trajectory of a 7% reduction in greenhouse gas emissions. And so essentially what you're doing by creating that benchmark then is putting this pressure on all those companies, might even be cement companies, might be some really heavy energy intensive companies, and you're putting this pressure on them then to reduce, by quite a significant amount, their CO2 emissions so that they can continue to be in this nice green index that's got the green European tick on it, and therefore large pots of money will flow in that direction. So those were the specialist benchmarks, but all the time in sustainable finance, we're distinguishing between like the niche, the green niche, and the whole of the market, because there's no point in making sure that the sort of 10% is squeaky clean green if the 90% is still destroying everything you're trying to achieve. So we also had, as part of the same legislative package, that providers of all benchmarks must explain the minimum content of how they achieve the ESG factors that Alex was talking about, so environmental, social and governance aspects. And so now all the big, what they call benchmarks, pots of investment that big money's flowing into, they now have to report ESG, so everybody can see what's going on there, which is, I think, you know, really putting a handle on the whole market now. And they have to, so they essentially have to make available to investors information. So investors can't sort of buy dirty investments without knowing about it. So that's the first thing. And that's sort of moving me on to the second bit of legislation, which is called mandatory disclosure, which is also not a very nice term, but in this case, at least it's descriptive, because mandatory means you have to do it and disclosure means you tell people what's going on there. So there's been discussion for quite a long time through, let me see if I get this name right, Task Force on Climate Related Financial Disclosures, that's right, which we heard Mark Carney, former governor of the Bank of England, talking about quite a lot. And that was like an initiative that said, we're going to phase out fossil fuels, we're going to tackle the climate emergency. A lot of the assets that you could be buying out there are what they call stranded assets, because as we move beyond fossil fuels, they won't have any value. So people that might buy them, especially pension funds, you know, I'm 57, but if you're 30, in less than 30 years time, we're not going to have any fossil fuels left. So if your pension fund buys investments in a fossil fuel company, they're effectively they won't be able to pay your pension. So you have a right to know whether your money is being invested in that kind of investment. So this came as quite a weak proposal from the Commission, and my Dutch socialist colleague Paul Tang and I and a few other shadow rapporteurs really beefed it up a lot and then fought it through the council, where again the Romanians were trying to water it down. But in the end, I mean, there's been some watering down since I was there when they do the technical standards, but effectively we have got a mandatory disclosure regime now, and European financial firms will be required to disclose how they integrate sustainability considerations into their processes in a standardized way from March this year. Now, it is mandatory, but there's this thing called comply and explain, which is if you're a really dirty financial firm or investor, you can say, oh, well, I'm not going to tell you. And basically, if they say, I'm not going to tell you, you draw your own conclusions. So this isn't exactly as good as fully mandatory, but this was the best we could get out of the council, unfortunately. But it is important that E, S and G are all included, which means that if there are very poor social standards, say, you know, abuse of human rights or just poor treatment of workers, then again, this will have to be reported. And of course, the need for reporting for financial companies puts pressure down the supply chain. So you have more clarity around what the corporations they're investing in are doing in the Amazon, or, you know, abusing workers in China or whatever it might be. Yep. We also, this was Paul's thing, I must say, he was very keen to make sure that remuneration policies are fully reported for the companies you might be investing in. So you find out if they're sort of a few fat cats at the top and everybody else not being paid very much. And also they have to report due diligence policies on how they take these sustainability factors into account when they're looking at the companies they invest in. So that piece of legislation means that people now have far more information, and they must have that information about what the financial companies where you might choose to buy an investment product or a pension or whatever, what they're doing with your money. And it was quite extraordinary when we were arguing for this. You know, I was speaking at vast number of public events inside Brussels and across Europe, and with some of the finance houses and pensions, especially the pension funds and insurance companies who are going to lose the most as we go through this crisis, some of them were up for this. But some of them really thought it was legitimate for you as an investor to not have any idea what they were doing with your money. I found this quite extraordinary, and I was sort of arguing, you know, it's a little bit like the horse meat scandal. when you find out that actually you haven't got beef, but you've got horse in your lasagna, everybody says that's a scandal. But when you find out that actually, you know, they're murdering indigenous people as a result of your money, you're supposed to not even know about that. So that is essentially, in a nutshell, the argument for mandatory disclosure. And we do now have that in the European Union. We'll see what's happening with the UK in a minute. So the third bit of EU legislation is the taxonomy. This is another hilariously European kind of word, isn't it? The sustainability taxonomy, which just means like, it's like a categorization of what's a sustainable industry to invest in and what isn't really. And there was a lot, I think the Commission came up with a pretty good proposal. So they had 5 things like, you know, improving the cleanliness of waters, reducing pollution, obviously renewable energy and so on, a list of things that, yes, we say this is green if it's in these sectors. And by January the 1st next year, investors managing these funds we were talking about before will have to explain how they use this system or taxonomy and how they're using that to measure the sustainability of their investments. There were quite a few interesting battles along the way, as you can imagine. For example, the nuclear industry were claiming that they were a sustainable industry and should be included in the green taxonomy. And my colleague, Bas Eickert, we had quite a few discussions about whether to fight that, but he decided to fight that in the Parliament, and he won that. He's such a risk taker. He won that by about 6 votes in the Parliament. And so nuclear is now excluded. He then had to argue that with the Commission and with the Council, including France. Anyway, we did win that. So nuclear, you'll be pleased to hear, is not a sustainable investment. And gas has also been excluded, which I find very encouraging. So we did lose on some of the detail of what's sustainable, but I would say we won on the principle. And it's really important in terms of signalling, because we're now saying these are green, sustainable investments for the future, and these really aren't. And so just as Bruce was pointing out, that people are now shifting their money into the sorts of companies that they realize will be where the money's at, where the economic activity's at in the future, the tools we're using here are giving them the information to do that and really signaling the sorts of things that are just not worth investing in because they just won't have a future in our sustainable economy that we're moving towards. I realize I'm a bit too much detail here, but okay, I'm going to give myself 5 minutes and then 3 minutes for each of my points, if that's okay, Alex. So big question, we're leaving the EU. Will we still have to conform to any of these laws? I would say that's still quite unclear. You'll notice that in the Brexit deal, the government did not get any sort of package for the finance sector, although it's really big, important in terms of us paying our way in the world and 1 in 14 jobs. My view of why they did that is because they're going to reduce standards in a way that wouldn't be acceptable to the EU. I hope I'm wrong. We have to keep an eye on that. But the government is posturing quite strongly on this green finance agenda. So next year, for the first time, they will issue a sovereign green bond. And that means when they issue a bond or sort of borrow money, they will do that specifically to pay for green investments, maybe offshore wind. So that other governments have done that, I would say that's a positive sign. They say they're going to have more robust environmental disclosure standards. And they say they'll be the first country in the world to make these task force on climate related financial disclosure. So telling people the climate impact of your investments, making that fully mandatory by 2025 and going beyond the comply and explain approach. And they say that because the EU, as I already said, only got as far as comply or explain because of Eastern Europe. Anyway, so they're now saying we're better on the green agenda than the EU. But to be honest, if they were doing that, I think they would stick with EU standards and then gold plate them, not abandon them, which is what they seem to be doing. And they say they're going to implement their own green taxonomy, like they're going to implement their own carbon trading system, but actually it's going to be exactly the same as the EU taxonomy. And this is one of the weird and slightly amusing things about Brexit, that we have the right and the power now to make up our own standards on everything, but we just don't have the time and the people to do it. So yeah, we're still going to be following a lot of EU standards, which is basically a good thing. Right, so 3 final points to close. A lot of what we're talking about tonight is about private investments and guiding private investment, but we mustn't lose sight of the importance of public investment, because a lot of the things we need to do to invest in the sustainable future will not make a profit, and therefore they will not attract private finance. So one way of doing that is to have a public development bank, and the European Investment Bank is such a thing, and it's now turned itself into a climate bank after massive pressuring from myself and my green colleagues. And until quite recently, they were investing in, for example, gas pipelines that have a 30-year built-in investment return period. In other words, beyond when gas will have to be phased out. So, but anyway, they've stopped doing that now. The European Investment Bank has provided the investment for some really significant green investments in this country. For example, the wind farms out at sea in the North Sea. We don't have access to that now. That really matters because the EIB can put in some of the risky finance, and then private finance can come in as well. So we need to have a green bank in this country, and there's no signs at the moment that we're going to do that. Secondly, we need to have a nice public development bank like the KfW in Germany, which is just a wonderful thing, which was set up using Marshall Fund money to rebuild Germany after the war. Because it's a public bank, it doesn't have to make any particular return on its investment. It can be guided entirely by what the society needs money for. And it then funded the reunification of Germany and poured a lot of money to Eastern Germany. It's now funding the green transition. So we need a public development bank like that, and regional public banks as well. We don't have any of this infrastructure at the moment. So no matter how much Johnson or Sunak say they want to do this stuff, they simply haven't got the tools there to create the cash to make it happen. And finally, while we're on green finance, I just wanted to say that this is going to be a big theme at the climate talks in Glasgow at the end of the year. What does green finance mean in terms of climate action? At the moment, it's tending to mean investment houses in the richer countries buying up bits of land in the poorer countries to absorb their carbon emissions. So we really have to keep a close eye on this, because if we allow it to turn out in that way, it will effectively be a sort of new round of neo-colonialism, where instead of addressing our own climate emissions and excessive CO2 producing behavior at home, we just kind of offload that onto countries in exchange for cash, and that would be entirely wrong. So that's all. Look forward to hearing questions later. Thanks.
That's great. Thank you so much, Molly, for that great insight into the regulatory side of green finance and the workings of the European Parliament. I think it's quite unique to be able to listen to Molly, because not many of us will be able to do that. So thank you very much. We're now going to move on to our third and last speaker, James Ellman. And please don't feel shy to post questions in the chat as well. Although you'll have the opportunity to ask questions during the Q&A session as well. But feel free to do that. My colleague James Hewitt will be monitoring the chat. Okay, so over to you, James. James Ellman, that is.
Great. Good evening to all of you. Thanks so much for taking the time to Zoom in tonight. Alex asked me to introduce myself. So I am James Ellman. I am a recovering hedge fund manager and mutual fund manager, and I now write books on history and stock market investing. And yes, I have written a book, Hot Stocks: Investing for Impact and Profit in a Warming World. Came out just about 6 months ago. And this is a very exciting and remunerative time to invest in the green energy space, and a great time to move your portfolios away from the brown parts of the market, which are starting to be places where you will lose significant amounts of money, in my opinion, if you continue investing. Let's see if I can move to the next slide. I have a standard disclaimer as well. We'd be happy to make these slides available to you later, or they'll be up on the replay. So I'm going to move through my slides relatively quickly, and if you have any questions, we can go back to them later. First of all, I'm going to try and tell you about why green investing is becoming very important, and why a green or a green portfolio is going to outperform the market going forward. I want to help you understand how you want to think about migrating your portfolio to one that is more green in its composition. And then I'll finish with some specific stocks and market sectors that are positioned to either outperform or underperform going forward. So first of all, why is green investing so important? First of all, investors are paying attention, not just individual investors like ourselves on the Zoom call today, but if you take a look at the fossil fuel divestment movement, there's now, these numbers are slightly out of date, there's now more than 15 trillion US dollars that has dedicated itself or claimed that it will divest in a short period of time from owning fossil fuel hydrocarbon companies. The Climate Action 100 now has more than 40 trillion US dollars in it. These large institutional investors don't say solely that we will divest from brown industries, but more importantly, as their largest shareholders, they're sitting down with them and forcing them to change their business practices to reduce their carbon output and their impact on the environment. This leads to companies like Shell, under their pressure, changing the remuneration of their C-suite executives, so they now partially are compensated simply by reducing the carbon intensity of their hydrocarbon output, which pushes them away from petroleum, away from tar sands, and more towards natural gas and even investments in green energy. Mr. Market has really been starting to pay attention to what's going on in the hydrocarbon space and the green energy space. If you invested in green energy from 2000 to 2010, you lost a lot of money. That was because the technology was really not ready for prime time, and you had the need for massive government subsidies to make solar and wind power financially make sense. That's really changed, and the number of government rules that are starting to price in some level of externality costs to the emitters of greenhouse gases has started to impact the companies in the brown space. So if you take a look at these tickers, these are all US stocks. I'm looking at the bottom one, the orange, or the reddish line, the SPY, that's the S&P 500 over the last year, the world's largest stock market index. And you can see that it's done pretty well, but it's done a lot less well than FAN, which is an ETF or a collection, an index of wind power stocks. It's done even less well than LIT, which is a collection of lithium and battery stocks, and even worse than TAN, which are solar power stocks. And so you can see that over the last year, Mr. Market is really starting to pay attention to what's going on in the green energy space. And you can see how Mr. Market is starting to not like brown energy as much. Here you can still see the S&P 500 is the reddish orange line. This is again over the last 1 year. You can see how infrastructure stocks have, the IFRA has almost kept up with the S&P 500, as Mr. Market is realizing and investors are realizing that there's a great deal of infrastructure build that's going to need to take place to harden coastal cities against rising sea levels, more intense windstorms, more intense rain events, and water intrusion into drinking water. So infrastructure is doing pretty well. And then you can see the ITA, that's the aerospace and defense stocks. Something's got to give in government budgets as they spend more money on infrastructure and green energy. So aerospace and defense are hurting. And then the XLE, that's the traditional grouping of hydrocarbon companies like BP or Exxon or Lukoil, and you can see how poorly they are performing versus the overall market. So green is doing well, brown is doing poorly. I think that will continue. That's going to continue because of technology. The costs of producing alternative energy keep getting cheaper than hydrocarbons without taking into account any externalities that are produced from the hydrocarbons. The governments around the world are enacting policies, both on the legislative and on the executive level, which are constraining brown industries. And the costs of climate change are becoming increasingly apparent to those around the world and are starting to rise exponentially. This is probably the most important slide in my presentation. It just shows you how over the last decade, the cost of producing solar energy and wind energy have come down very significantly. The prices are continuing to fall, and you can see that producing alternative energy is now cheaper than producing most hydrocarbon energy, including coal and even natural gas. And again, this is without pricing in any of the externalities of any of the pollution that they put out. Next, on the political front, this chart just shows you how governments have been increasing the number of laws and executive rules from different governments around the world that have been constraining brown industries that pollute the environment. And you can see that from these green circles here, this is a couple of years old, but the green circles have grown slightly, but even China has now set out carbon pricing rules, and those are growing. We may see more of the developed markets, the large GDP producing parts of the world that are that you see on this chart that don't have a green dot on them at this point, that don't tax carbon emissions, will start to tax carbon emissions. And again, that will push more and more energy production towards that in the green space. So we know that green stocks are outperforming and are poised to continue to outperform due to technology, investor choice, and government policies, how quickly should you be moving? And I think that this little chart can help give you a bit of a framework, which is the faster the societal change is taking place towards green energy and away from brown energy, the faster you want to switch from your base portfolio, which looks just like the index, the FTSE or the S&P 500, and the more you want to move your portfolio towards a green portfolio. That it will increase the chance that you will outperform the market over time. If you see or believe that society change is slowing down, and we've had societal changes or pushbacks against green policies. We've seen that clearly in the United States under the Trump administration trying to pull out of the Paris Agreement. You've seen that in France with the riots over raising of petrol taxes. So will be hopefully a 3 steps forward, 1 step back process. Maybe it'll become 10 steps forward, 1 step back. The faster we as a society move towards a green, carbon neutral economy, the faster you as investors probably want to consider moving your portfolio to a green portfolio and outperforming. So now I'm going to try and move on to just finishing with a few individual sectors that are poised to outperform or underperform going forward. Now, first of all, of course, the hydrocarbon industry. There are some tailwinds to the industry. We've got large parts of what are usually called the developing world in India and China, Indonesia, that have a large growing middle class. They want energy. They want to live just like consumers in England or the United States do. So they need electricity. They need ways to power their vehicles. And hydrocarbons are the way most of the world do that right now. However, the headwinds are many and are increasing. And of course, as we've talked about, governments are starting to tax the externalities on the release of methane and carbon dioxide from the burning of hydrocarbons. Many countries are phasing out ICE or internal combustion engine vehicles after 2025, 2030, 2035, depending on the country. So it's going to be harder and harder to buy an ICE vehicle. You're seeing the costs of generating alternative wind or solar or even geothermal power coming down rapidly, and the cost of battery storage to store that intermittent power so that it's dispatchable when it's needed. Those costs of batteries are coming down just as fast as the cost of producing solar energy. We've seen that many brown industries have started losing their access to basic business services that they need to operate. Many British banks, many banks around the world are no longer offering banking services or investment services to companies that are the brownest in the hydrocarbon space. Many insurance companies will no longer insure new coal-fired plants or drilling in the Arctic. So it's going to get harder and harder for these companies to even operate as they want to expand their production. If you're going to avoid investing in the hydrocarbon space, I would highly suggest you want to look at a chart like this one. It shows you the major hydrocarbon companies in the world, and it ranks them by their carbon intensity of their output. So you can see, surprisingly, the Canadian stocks are the worst offenders here because Suncor and Husky and Canadian National are engaged in a lot of production of tar sands into synthetic crude oil. It's a particularly carbon intensive method and process. The other companies here on the left-hand side tend to do a lot of drilling for petroleum. The companies on the right-hand side primarily produce natural gas. And natural gas, for better or worse, is much less carbon intense than coal or petroleum or diesel fuel, and is hopefully or likely to be a bridge fuel as we move to a greener, more alternative energy production in the world. Next, moving on to alternative energy operators. These are companies that I think are well positioned. They've been outperforming. Bruce mentioned Tesla. He mentioned Ørsted. Ørsted's right here. Again, that used to be the oil company of Denmark. They're now a major player in the wind space. Azure Power is a company making solar panel farms in India. If you want to invest in geothermal power, Ormat is probably the best pure play out there. There are many operators of the big solar, wind, or geothermal plants that are out there in the world, and many more are being built all the time. You can also invest in the equipment manufacturers for wind power or for solar panel power. You've got a large number of choices around the world. You can invest more locally in Europe. You can invest in the United States. You can invest in China. In general, I would suggest you want to focus on companies in Europe and the United States, where the companies are a bit more focused on getting some of their revenues to the bottom line and generating profits. Too many is my experience as an investor in China. The manufacturing companies spend a bit too much of their time focusing on gaining market share and keeping their people employed, and let the profits take care of themselves next decade. And it always seems to be, for many of these companies, a decade that never actually arrives. Next, infrastructure. Mentioned that there's massive need for infrastructure building because of climate change. There's going to be a great deal that's needed in Europe, in the United States, and in northern coastal China, primarily because these areas have major urban areas, major GDP export or production parts of the world that are in low-lying areas that suffer significant wind and rainstorms. So you have the double whammy of both rising sea levels impacting these areas, as well as more intense windstorm events. The United States is likely to see the biggest jump in infrastructure spending in the next couple of decades, primarily because the United States has been massively underinvesting in infrastructure for the last 20 years. It seems we're on the cusp of a major political change. We can hope that continues under the new Biden administration. The United States currency is still the global reserve currency where people want to park assets. Yields are very low, and actually U.S. personal savings rates have gone way up. Most people in Europe may think of the United States as a nation of spendthrifts, but actually personal saving rates in the United States have been rising to levels more akin to those that you'd expect to see in Germany or Switzerland. And we have well over now more than $1 trillion sitting around the United States looking for positive return on investments. And for example, the U.S. Transportation Authority, Federal Transportation Authority, says that every $1 spent on road improvement in the U.S. right now has a return of close to $5 in increased economic output. So a significant multiplier effect on investing in infrastructure. These charts are from the American Society of Civil Engineers. You can see that on the left-hand side, the amount of capital in dollars that have gone into infrastructure have fallen quickly. That means a lot of infrastructure has been crumbling, which means the cost of just operating and maintaining it keeps going up. That's that yellow line. And on the right-hand side, you can see the huge gap that is there that needs to be built in infrastructure, and then how much of it is unfunded, with more than $1 trillion just in road building that needs to go into U.S. infrastructure in the next decade. And if you don't have that, the infrastructure starts to fall apart. And that's even before you take into account big hurricanes and sea level rise starting to erode the roads that need to be armored or need to be elevated as climate change impacts become more and more prevalent. These numbers here are from the ASCE again. They give out a report card every year. They have to update it every 5 years for how the U.S. infrastructure is doing. You can see again surface transportation. You see the D and the C. C+. The C+ is for U.S. bridges. We at least have put some money towards the bridges in the last 5 years. So we've moved all the way from a D to a C+. But you can see again, we've got a lot of Ds, a terrible report card, and more than $1.5 trillion needs to go into basic infrastructure in the next few years. Where to invest your money? to take advantage of this. First of all, engineering construction management companies like Jacobs in the US, WSP in Canada, or Arcadis, which is a Dutch company that specializes in water management, is a great place to look at investing your dollars or your pounds. These companies don't have really any capital at risk. They're just pulled in to help manage the really large infrastructure projects taking place around the world. And of course, I mentioned road building is going to be one that needs a lot of work going forward. Also building levees, seawalls, sea barriers, and you've got very boring companies that just make concrete or the gravel and the asphalt for roads, such as Lafarge out of Europe, or Vulcan Materials and Martin Marietta in the United States. As a hedge fund manager, if I'm going to talk about something that you want to invest in, I always have to tell you where not to invest, where to take your money and under invest in an index or even go short. And again, I've mentioned before, I think defense, along with hydrocarbons, are a place you don't want to be investing going forward. Something's got to give in terms of the budgets of big governments and what they spend in defense. Yes, climate change is unfortunately likely to lead to more violence, more refugees going forward. However, it's probably not what sort of problem that's going to be solved with a multi-billion-dollar aircraft carrier or $100 million fighter jet, which is basically what most of these defense companies make. We know that infrastructure is going to be eating up more and more of government budgets. And then, of course, COVID-19 has just blown a hole in government budget deficits. And this chart here, this is from the FT late last year, and it shows you that already we had too much debt across the OECD, but the spending for COVID-19 has really made that much worse. And governments going forward can't just continue to spend over 100%, more than 100% of their GDP in debt. That's a very dangerous place to be. Something's going to have to be cut in their budgets. So I would recommend that if you own BAE or Lockheed Martin or Huntington Ingalls, these are not stocks you want to own going forward. They build very expensive military systems that are likely to be on the chopping block going forward. So I'd like to summarize now. Again, there are several different factors that are moving our civilization and our economies away from brown industries and towards the green ones. Most important are just costs and technology. That's not something that's going to go away. It's going to continue. Investors have already begun moving away from brown industries and towards green ones. I would suggest you want to be at the front edge of that. Doesn't mean you have to switch everything today, but you probably want to consider doing that over time as society changes. There are certain sectors that are well positioned for the next 20 years. There's some that are poorly positioned. In my book, I go through several other sectors, but I wanted to keep my comments brief today. And again, today's presentation and comments is just the starting point for what I would hope would be a longer discussion and a dynamic discussion going forward regarding investing in a green world that we are now going to be living in, hopefully over the next couple of decades. So with that, Alex, back to you.
That's brilliant. Thank you so much, James, for that great insight into the markets and how things are moving towards green investing. So right now, people can put their cameras on if they want. They don't have to. But this is the Q&A session. So just maybe contemplate a bit what the three speakers had to say, what really three very interesting and different angles there to the topic. And feel free to ask a question. The way we're going to do this, or were going to do this, was to alternate between questions directly to the panel or the speakers, and then maybe take a question from the chat. But we'll just see how it pans out in any case. So does anyone have a question? Bruce.
Well, I thought that I would kick off a question to Molly and ask what is the EU's position when it comes to the indices and everything on offsetting. I personally don't like offsetting at all. I think if you've got to reduce the stuff, you've got to reduce the stuff. But what's the EU's position?
Well, I wouldn't say there's really an answer to that question because the EU isn't a thing. You know, it's like 27 member states now plus the Parliament. And offsetting would obviously be different in different legislative proposals. But certainly as Greens, we agree with you. I mean, offsetting's mostly a con. So, I mean, if we're saying, for example, in the benchmark legislation, if we're saying you have to reduce your carbon dioxide emissions by 7% a year, you couldn't do that by paying somebody else for carbon credits. You would need to do that yourself directly, and that is stated in the legislation. Or similarly, you know, for example, in the taxonomy, you have to actually achieve the carbon reductions or the sustainability achievements yourself. You can't use money because since you can make up money, you know, if you're a bank, it's completely futile to allow people to make up money and then exchange it for real stuff. That is not, you know, that is the ultimate misunderstanding of our economy. You can't exchange made up capital, money, for real things. You know, there's just not an equivalence there, and it's because we're trying to do that we're not really addressing these issues. So you absolutely have to have hard brakes. And so, for example, as the Green Party, one of our tests around is a proposal by the government on climate change. A good proposal is, are we doing the heavy lifting ourselves domestically for real, rather than like buying some land in the Gabon and planting some trees on it? That doesn't count, ever.
Thank you very much, Molly. Okay, so I'm going to ask James Hewitt, if there are any questions from the chat, or if he has any questions himself, in fact.
Oh, I'm going to adapt a question, again about aviation and defence. If we don't invest ourselves, will that hand a competitive advantage to the Chinese or our competitors? And that
I think that, sure, that's a very good question, one to be concerned about. I just actually had a history book released yesterday that right in the beginning, it talks about how the United States is handing off hegemony to China in the world. And yes, I think that is taking place. I just think that for better or worse, in London, in New York, in Amsterdam, the decision is going to have to be made. How many very expensive F-22 fighters are we going to buy versus are we going to build seawalls to protect our big cities, or are we going to have to just abandon those cities to flooding increasingly and move inland? And I believe that going forward, as the storm problems get worse, and particularly in the United States, as infrastructure is actually crumbling and needs to be replaced, less will be spent on defense and more will be spent on infrastructure. And certainly there's not too much around the result, which is that the West's preponderance in defense technology is likely to slip versus its major competitors in both China and Russia.
Can I just check, was that question about defense, or can I answer a wider question about China?
Sure.
Yes.
So the point about the mandatory disclosure is, if you're a company, if you're an investment company and you're investing in a company that is manufacturing stuff in China to low labor standards, for example, then that will now be reported. So that's one thing. That's one of the things the mandatory disclosure achieves. And that in itself is now putting pressure on companies like Nike or whoever to actually monitor their supply chain better, because they used to turn a blind eye. Mandatory disclosure says if you turn a blind eye, you won't be receiving investment anymore. The second thing is that the EU is specifically monitoring supply chains. And this started out, again, this was a green initiative, and it started out with conflict minerals. You probably know that the 5 Ts, 5 special metals that are used in smart screens and mobile phones, you know, smartphones and all that stuff. A lot of them come from the Congo, and they're actually paying for child soldiers and maintaining the civil war there. So my very good friend Judith Sargentini of Dutch Green started this process to initiate legislation to prevent that, and that was passed and came into force about a year ago. So now any company that sells products in Europe cannot use metals produced in the Congo, and that's just the first example. And we need to move on to manage the supply chains, you know, to eliminate effectively unsustainable unsustainable components or elements used in the manufacture of products. But then you can very rightly say, well, we're just making ourselves uncompetitive then, aren't we? But the point is then we have to start applying what they call border adjustments, but basically that's a tariff when we import goods. And the debate about the border adjustment has reached quite an advanced stage in the case of climate action. And I think this is why we saw China finally adopt a net zero carbon target of 2060, although of course that's late, because they could see that the EU was getting serious about raising our own climate ambition and then making sure that other countries don't undercut us by not reaching that climate ambition and then just selling us cheap goods, effectively climate dumping. And the border adjustment discussion is to prevent that happening.
Okay, thanks for that answer. I think, has anyone got a question? I know Bruce has a question.
So I was just going to ask an extra one on
yeah,
James.
sure.
I mean, there's been a very successful campaign to get the fossil fuels out of the way and various other things to make them unpopular as investments. There are clearly other things which I mentioned that come into that ethical area, such as palm oil, the way, not necessarily all palm oil people, but the companies that do use palm oil in an irresponsible way. The question I'm going to ask about defense, given the fact that the US military itself contributes 10% of the global ecological footprint, do you think there is a chance that there will be an investment move to start disinvesting from armaments on the basis that actually sustainable planet doesn't have a place for militarism? Now, I know that in the United States, it's a special thing because every senator has got a defense company in it and everything else. So it's different from the rest of the world. But could I have your opinion on that?
I would hope that or such a scenario would play out. It would be very hopeful for the world. Unfortunately, Bruce, I don't know if that's going to happen. I think it's more likely that defense will have to be cut in the United States, not due to the carbon footprint of the US military, but just due to the cost and its drag on the US budget. One point I will make is that US military planners do see climate change as a major security threat to the United States and its allies. It does see hydrocarbons as a major concern to its ability to project force going forward. And it has been pushing quite strongly towards investing in alternative energy transport, be it for their tanks or their aircraft going forward. One last point I would make on that is Joe Biden had promised that for all federal vehicle purchasing taking place once he becomes president will be for alternative, either hydrogen or battery hybrid vehicles whenever possible for all federal needs. And so I think we may see some of that start to take place in the military going forward as well, as that would fall under that umbrella.
Thank you. So has anyone else got a question for our speakers?
Sorry, I can't turn on my video.
That's okay.
Yeah, I've got a question, just a general one. How there's a lot of oil and coal in the ground. How do we persuade kind of Saudi Arabia, Venezuela to keep the oil in the ground, or Australia to keep the thermal coal in the ground? What's the economic pressure to do that? A strange question.
If I could just start on that, I think the real pressure is going to be costs, which is now in places like China or in India, a preponderance of investment in new electricity production facilities are in either wind or solar, not in coal or petroleum. And as the costs of producing energy from alternative methods versus hydrocarbons continues to fall, and hydrocarbons continue to become more expensive without pricing in the externalities already. If you add the externalities in, the hydrocarbons become that much more expensive. That means that many of those reserves from countries and companies have of hydrocarbons in the ground are becoming stranded assets that will likely never be pulled out of the ground for energy needs. Bruce?
Can I just add to that? The way we stop them is to stop buying their product. It's not Shell, it's not BP who consume the petrol they make for us. It's us. We put it in the tanks of motor cars. Don't have a motor car, have an electric car. Go by public transport. That will persuade them.
Yeah, I take a slightly different view on this. And what I think is extraordinary about the sustainable finance agenda is that we're not moving beyond fossil fuels because we're running out of fossil fuels. We're moving beyond fossil fuels because we're agreeing as an international community that we have to do that to preserve the climate for future generations. And that, in my view, is an extraordinary political achievement, even though we're not doing it fast enough, and even though we haven't succeeded yet, and even though although fossil fuel stocks are coming down, they're not in value, they're not coming down anything like as fast enough. So partly what we're doing here with the sustainable finance agenda is signalling, saying don't put your money in those, they're stranded assets. But as the questioner, John, I think it was, pointed out, that there's still an intrinsic value to coal. I can chuck it in my fireplace here and it's still going to burn. So it is still going to have a value. And as we stop using it, its value will not decline because it still has that ability to be burned. And what we're going to see is like some dirty economies, and Australia is already signalling it's going to be one of these economies, and Russia will be as well, although it's not signalling so clearly. And they will continue to use fossil fuels, and we have to turn them into international pariahs and limit them as much as possible. But nonetheless, because these things are still useful, they will continue to be used. And what we need to do is to introduce a carbon tax, a global carbon tax, by agreement through the UN. And this is what the Green Party is mostly going to be pushing in the run up to Glasgow, so that it becomes just far. It is already, as I agree with James, it's already becoming very expensive because renewables are out competing in terms of electricity generation, but we have to make it expensive and increasingly expensive. You know, we need this curve on the price of all fossil fuels, and we can do that by introducing a carbon tax. So, you know, eventually, okay, coal is so expensive, you only use it for jewelry, and no, not quite that bad, but certainly petroleum you will only be using to make plastics when we can't use anything else other than plastics for certain products. And we're going to do that by having a carbon tax, and the yield from the carbon tax has to be shared on an equal per capita basis with everybody across the world. And that's what we mean by climate justice, folks. That's my argument.
I don't want to diminish what the politicians can do, but actually, if you look at the reality, the major tsunami of movement away from the fossil fuels was led by BlackRock and by the major financial players, not by politicians.
But do you know what, Bruce? That's because the politicians were talking to BlackRock. I myself talked to BlackRock. It's signalling to them very clearly. And actually, it wasn't just us as politicians. It was the insurance and pension funds. So Aviva did a fantastic job here, coordinating that discussion. And Nick Robbins and his gang did an amazing job after Copenhagen, creating this idea of stranded assets and ultimately convincing people like BlackRock that there wasn't going to be a future in this. So it was a combination of intellectual effort and political determination to create that signal to convince the financiers that the money wasn't there, because they could still make money out of oil. I agree with John. You know, you could still drive a petrol car, and people in many parts of the world will continue to do that. But we have to create the coalition of, and we are doing this, of the economies that will no longer tolerate fossil fuels. But yeah, so I mean, it's a combination of the two. I'm not entirely arguing with Bruce, but depending on when that happened, that was precisely the purpose of the work being done by the Task Force on Climate Disclosure and all of those people for the past 10 years now.
Okay, I know I'm sharing, but I actually have a question for Molly and the other two speakers. But but more specifically for Molly, on the Young Greens website, they have put something about the working towards the downfall of capitalism. Now, I want to know, does capitalism have a role to play in making the world more environmental? And it's a difficult question to answer, but how and what are the warnings that we need about that?
The reason I'm laughing is because I wrote a book in 2004 called Market Schmarket, Building the Post-Capitalist Economy. But all the Young Greens think I'm incredibly, right wing, because I then got elected and worked on the sustainable finance agenda and talked to a lot of finance companies. So they haven't invited me to talk at their presentations, which I'm kind of slightly sad about. But anyway, maybe I've just become a pro-capitalist in my old age. I don't think I have, actually. So, I've got a whole presentation on this, Alex. I can't really go into it in much detail in answer to your question. But at the moment, what we're doing is we're mobilizing the power of global capitalism to resolve an urgent issue very quickly. And I would say that's working. But ultimately, I think capitalism is not a sustainable economic system for two reasons. One reason is it depends on growth. It has a money creation system based on interest and based on creation of money to stimulate demand. And that has a growth dynamic built into it. So you'd have to redesign that whole system to make it sustainable. And I think if you did, you couldn't legitimately call it capitalism. That's one thing. And the other thing is it relies on the accumulation of further capital. And that also has an inbuilt growth dynamic. So for both those reasons, we are dealing with an emergency now with the climate. But beyond that, capitalism will still have this incentive to grow, to persuade more people to buy stuff, to repay investors. And so it's going to continue to gobble up the globe, I think. And therefore, I can send you my presentation where I make this case at much greater length, or even my book from 2004, if you wish.
Great. Thank you very much, Molly. I'd like to hear what Bruce and James have to say.
My simple answer to that is I'd love to understand an alternative system that works as smoothly as capitalism does. I don't think it's perfect. It's spent a couple of thousand years trying to get perfect. It one day might become more perfect. I don't believe in this growth thing. I think that you can have stable capitalism. I think that's as good as system as we've got at the moment. And if somebody wants to overthrow it, then don't try and don't fix it unless it's really and truly broke.
Great, thank you.
I come from a capitalist. Sure, I come from the background of capitalism, and I would say that to paraphrase the fictional character Gordon Gekko, greed is good, and it is purifying, and capital flows to where profits are highest. There's a reason why, as Bruce mentioned, Tesla stock has gone up so much. I drive a Tesla, I have a Tesla Powerwall, I own Tesla stock. Why am I involved? I'm involved because it looks like a great place to make money going forward. The largest coal stock in the United States, Peabody, is no longer in the S&P 500. It got too small. Investors don't see a future in profits from digging coal out of the ground to sell to people to throw in their ovens to make heat or electricity. So particularly if we can get governments to start imposing more rules, regulations, and carbon taxes on these companies, we will see capitalism move by itself simply for where profits are to where the profits are going to be. And that is going to be increasingly in towards a more of a green future and less of a brown one. But there's a role for consumer choice to play here. There's a role for governments to help to direct capitalism. And then capitalism has to perform what it does with its invisible hand and move capital to where profits are highest.
Great, thanks a lot, James.
Can I ask something?
Yes.
If we have to regulate it so much, is it really an invisible hand?
I think that's a very good point. But look, I should say, I think the market works very well in the distribution of private goods, as long as people all have a fair amount of money to choose which private goods they're going to buy. So you know, a system of central planning is absurd for things like shoes. But I think there are lots of areas that are currently dominated by the market that don't work well. And I think now we're living in a financialized form of capitalism where finance is actually in many ways starving the real economy of the investment it needs, because it's much easier to make money through speculative investments. But I mean, I take, you know, I'm arguing for the regulation of capitalism here. I'm not actually arguing for the overthrow of capitalism, but from a theoretical point of view, I think if you look at all sorts of figures since we became, you know, the amount of resources we've used, the amount of pollution we've put out, the amount of land that's been degraded, all those sorts of things have just, you know, there's the hockey stick curve once people started making money out of investments. And I think that's an inbuilt flaw with the system. And I do have proposals for replacing it, which are around localizing, changing ownership structures, so the people who work have an investment, you know, organizing it much more through cooperatives, not through external investment, and then people accumulating capital who haven't put in any work, which is also part of the problem. Anyway, we've gone past our time, and this is a big subject, but I think you're right. You know, Adam Smith made this point about the invisible hand, but he also had another book called The Theory of Moral Sentiments. He wasn't so hot on politics, but no, there's very few people who would argue for totally unregulated capitalism. And the US itself, you know, invented a lot of the antitrust legislation when companies became too large and too powerful. And I would say Joe Biden's probably going to do the same thing now with a lot of the tech monopolies, as should indeed be done. So capitalism needs to be well regulated. Yeah.
My comment would be that capitalism has always been regulated by government. Take a look at a vast number of products that you use every day. When you buy alcohol, there are taxes on it. Nobody really seems to complain that you don't make your own alcohol in a still, that you go to the corner store or the supermarket and you pay a tax, and that tax reduces demand because it drives up the cost. Even in the United States, there are only certain guns you can buy. I don't think you can buy a tank of your own yet, but that may be coming. The government has regulations as to certain monopolies for telecommunications, for your mobile phones. There are only a certain number of players that have been given licenses. The government has always interfered with capitalism. It has always directed the rapaciousness of the invisible hand, and there's a place to be for the government to play its role, and I believe most capitalists would agree with that.
Okay, great stuff, everybody. I think we're going to have to end there. I just want to say thank you, really thank you for attending and for speaking. I think it's been very engaging. And I think we have a lot to think about after this event. And I'd just like to remind everybody that West Central London do other events. And if you are interested, please check in the chat. I've put the website for our events. I think we're going to have events on, possible events on insulation, instead of talking about how to conserve energy and not waste energy, about insulation in the coming months, and also one on vegetarian and vegan cooking. So I just want to thank you so much, Bruce, Molly, and James, and thank you everybody for attending. James has a whole day to get through now. It's
but lovely weather.
Lovely weather,
yeah.
And it's not even mid-morning, is it? What is it?
9:39 a.m.
9:39 a.m. So just thank you so much for participating, and yeah, thank you. And that's it, really. I'm gonna.
Well, thank you.
Thank you very much.
See you.
Thank you.
Yeah.
Bye,
And thanks to my son for being a cheerleader silently in the background there. Thank you. Thank you, Charlie.
Bye.